So thanks so much, Ani, for hitting record, and thank you all. Hello, everybody. Thanks for joining. My name is Delilah Rothenberg, and I'm a co-founder and the executive director of the Pre-Distribution Initiative. For those of you who are not familiar with the Pre-Distribution Initiative, we're a multi-stakeholder initiative designed to co-create improved investment structures that share more wealth and governance influence with workers and communities, and to have investment structures really that are better aligned with investor stated ESG goals and impact goals and risk management goals in general. We recently wrote a paper called ESG 2.0, Measuring and Managing Investor Risks Beyond the Enterprise Level. And that looks at a couple of key trends that are happening in the financial system and the real economy. And if I could just ask everybody to please mute yourselves. Thanks so much. So ESG 2.0 looks at how investor migration up the risk return spectrum for yield has some unintended negative consequences, as well as how the institutionalization of capital has resulted in the consolidation of capital flows, which can also have some unintended negative consequences, which run counter often to investor stated ESG goals or just risk management goals in general. And so the paper concludes with really exploring what kinds of investment structures and asset classes and emerging asset classes can better align with responsible investment. So there's been a lot of great work in the more niche impact investing space when it comes to revenue-based financing and equity redemptions or structured exits more generally. And there seems to be potential around these investment structures to support investors in their goals, as well as entrepreneurs and other stakeholders and their goals as well. I recently started, I started to learn about these structures a few years ago. Transform Finance published a paper on these structures in Latin America. Candide Groups, Aner Ben Ami wrote an article, Don't Go Chasing Unicorns, which if you read our paper, you'll see as referenced there, and had a big impact on our thinking in terms of the return potential of these structures for investors and how they might fit in investors' portfolios. Aner introduced me to Zebras Unite, which is a movement raising awareness about these structures. And as I got more into this space, I learned about Kauffman Foundation's Capital Access Lab and Village Capital and attended some of their programming around these structures. So there's a lot of great stuff happening in this space, and I'm really pleased to say that we have some folks participating from those organizations today who can help kick off the interactive part of this discussion and share their experiences with you from being active in this space. There's also been some activity in mainstream markets with revenue-based financing and equity redemptions and structured exits, but overall, there really hasn't been a lot of momentum built yet. These are not really considered asset classes or an asset class or investable asset classes by institutional investors, and there's not a lot of awareness among institutional investors about how to fit these strategies into their asset allocation frameworks. So it's also important to note that these structures are not a panacea. The devil's in the details on structuring. They can be structured in extractive ways. And so when we think about scaling the space and creating investable asset classes, it's important to keep that in mind. And I hope we'll get into that in the interactive dialogue. So to start, I'm so delighted that we have Ani Patton-Power joining us. She recently wrote the book Adventure Finance, How to Create a Funding Journey that Blends Profit and Purpose. Sorry, can I just please ask everybody to mute themselves? There's some background noise. I think it's coming. Okay, great. Don't have to name names. Thank you for turning your mic off. So Ani wrote the book Adventure Finance. I highly recommend checking it out. It's a great read. We'll put a link to the book in the chat. But it's an entire book on different ways to structure investments that support both entrepreneurs and investors. And Ani is going to present some aspects of the book today that are relevant for this conversation. And then we'll have a few participants, as I mentioned, share experiences and perspectives to kick off the interactive dialogue. That will be the second half of the program, and we'll end at 12:15. I do really want to stress that this is intended to be an interactive dialogue and workshop style. So please do bring your questions and your comments. Feel free to use the chat throughout the program and raise your hand using the raise hand function, or or visually if you don't know how to use the raise hand function, and Dimitri from 17 Communications, and I will keep an eye out for your hands and moderate. So with that, I'd like to hand it to Ani to bring us through some introductory framing and talk about the book. Thanks, Ani.
Thanks, Lila. I'm glad that you mentioned all of the people you mentioned at the beginning. I put some of the reports in the chat because they were all very influential for me as well. And I see some of them on the call, which is great. So Andrea, I mean, the Transform Finance report was just such an incredible resource. And the work that others of the respondents also are going to be talking about is excellent. So I'm going to jump in because of the background of all of you on the call. I'm going to go pretty wonky. So, please feel free to ask questions, but, don't always have an opportunity to get as, I would say, as detailed or as technical as I'm going to just dive into. So, the reason that I wrote the book Adventure Finance was because I really didn't have a single resource to be able to help entrepreneurs as well as investors understand the spectrum of options that they have from an innovative financing perspective. I've been teaching and doing this type of work for about 12 years and lecture executives as well as entrepreneurs and funders and really, I needed a resource, and I needed this for a bunch of reasons. One was that I've created some of these structures, and people think that, for instance, social impact bonds are the only type of innovative finance. And then also, for the other reason, on the completely other side, is that I personally have struggled with the traditional equity structure as the default impact investing risk capital structure since the beginning, since I got into impact investing basically 12 years ago, 11 years ago, however long it was, whatever 2009 was ago, I've forgotten now. And I think that for me, the issue has always been, the reason that my work is focused on financial structuring is that I believe that it is as important how we allocate capital as to what we allocate capital. And as impact investors or as organizations that care about mission-driven investing, putting money into social enterprises, often using very traditional structures, doesn't necessarily allow them to be able to grow the way they want to grow and to preserve the mission they want to preserve the mission of. So I think probably everyone on the call has some sort of agreement there. So I'm just going to go into some of the options that I profile in the book. This is an overview of the different chapters. So really, starting with, I've explained in the book, traditional share purchases and safes and kisses and convertible notes and unsecured and secured loans. But really today, what I'm going to talk about are the options of venture debt, mezzanine debt, which are relatively similar, as well as revenue-based financing, convertible revenue-based financing, and redeemable equity. And together, alongside, very interesting note also, the trade finance, invoice factoring, and supply chain finance for me is a very interesting option alongside some of these. But together, those four options make up a really interesting set of risk capital options that can be used for a spectrum of early stage companies and can be used to, in some ways, replace traditional equity or complement traditional equity. And as Delilah mentioned, can be actually used in portfolio constructions that don't necessarily require any sort of trade-off from a pure IRR perspective or from a cash-on-cash perspective. And so I'll talk about that in a moment as well. I'm not going to talk about any of these, but a whole set of the book talks about alternatives around grants and other types of below market capital. And so I encourage you to check that out. We'll put in a link to the book as well. So as I said, these are the four that I just want to give a quick intro to, and then we can have a discussion on, which I'm really looking forward to. I know there's some great experience in the room as well. So this spectrum that I have created, and I would say that the terminology and a lot of this is very unsettled, particularly in this category that I've created called convertible RBF, but I'm going to work from the left over to the right. So mezzanine debt is obviously, as all of you know, mezz itself is a catch-all term for pretty much everything. So I have defined mezzanine debt very similar to kind of venture debt in a lot of ways, as a debt agreement that is a loan that has a fixed interest rate and some sort of upside, either through warrants or some sort of profit share. So $300,000 loan, 5% interest, 2% of profits over a 5-year period. And this type of SME finance is a growing space. There's some really good work done on this by Dahlberg and by the Dutch Good Growth Fund not too long ago in a report on SME financing. Can be incredibly useful for companies that are looking at projects that have some sort of collateral, maybe not all collateral, or have previously raised equity funding or other types of funding and need an additional risk capital round, but do have some traction to be able to essentially use debt as opposed to another equity round, particularly from a dilution perspective. RBF, revenue-based financing. Interestingly, when I started writing the book at the beginning of 2020, and revenue-based financing was certainly happening, but I would say more so than any other structure I talk about in the book, RBF has had a significant amount of growth in 18 months. Some of you may have seen, I'll put a link on the chat later, Clearco has just raised $215 million for revenue-based financing, partially from SoftBank. They're US-based, they're the largest US-based revenue-based financing company in the world. And this structure is also a debt agreement. So it's a loan that is essentially given based off of the historical revenue. So sometimes as little as a couple of months historical revenue that's used as collateral in essence, and then is repaid as a percentage of that revenue. And what I've found is that it's a very versatile option that is being used in everything from how Clearco is using it often, which is tech companies looking for non-dilutive capital, particularly around marketing spend and around customer acquisition. And this can be used alongside or instead of VC funding. Has to be for post-revenue companies, but a lot of VCs are now interested in this because they don't necessarily want their portfolio companies to be using their growth to be buying Google AdWords. So this type of funding, which doesn't have, it's completely non-dilutive, so it's paid back sometimes very quickly. Another side of this that I'm also seeing, which is quite interesting on the impact investing side, is technology-enabled RBF that allows impact investors to do very small loans to organizations for working capital that are fast-growing, but certainly not unicorn companies. And so a great example of this is Viwala in Mexico, linked up to the Mexican tax authority, able to do diligence and get money out the door in 48 hours and looking at repayments over less than 2 years, but really working capital for particularly female-owned companies. And one of the things that I think is really interesting about this is it solves some of the issues we've had with an impact investing around deal size and around diligence, just really being able to get the type of capital that's needed to individuals, which often looks more like working capital than equity. Now, moving to the right, this is the category that I would say is the most difficult. This was a slippery category to be able to define. I called it convertible revenue-based financing. It was in a conversation, I had so many of these interviews trying to figure out what this one is. And the reason this is a separate category, and I would just say, and I'll talk about it quickly at the end, these are categories for understanding. The actual contracts themselves are, contracts made up of a series of terms which you can mix and match. But this particular one I think is quite interesting. It has a lot of different names. So demand dividends, variable payment obligations. I have a table in the book that has like 37 different names for this category. And so you've probably at some point, if you've seen some of these alternative structures, have seen some of these. What differentiates them from revenue-based financing is that they're a little bit closer to equity. So it is a debt agreement in essence. That's why I called it the convertible revenue-based, because it actually is a convertible note is what it's closest to. But it has investors essentially are looking for repayment as a percentage of revenue or cash flows or some sort of combination. And they have an option to convert into equity at a liquidity event. So this is being used. So Adobe Capital is an example of this. I've got a bunch of examples of this. And I see people on the call that I know have used these, and they provide the ability to have some upside, but also the ability for the underlying entrepreneurs to access this type of risk capital. So it does need to be post-revenue, I would say 90% of the time. There are some kind of arguments that it could be. I'm sticking to what I've seen is that it works for post-revenue companies, but there is this option for upside. So if the entrepreneur isn't sure if they want to raise equity in the future, they don't want to necessarily get on the bandwagon, but they might have an option potentially to be bought out, et cetera, that there is this ability to use convertible RBF. Now, moving all the way to the right, which is very, very close to equity and a structure that I think is particularly fascinating, just out of all the different ones that I have looked at, something called redeemable equity. Well, I call it redeemable equity. It has a lot of different names as well. So essentially, it is very similar to traditional equity, either a priced round or a safe. So there's redeemable equity that looks like safes as well, where a certain percentage of the company is sold for a specific amount. And doesn't have to be a certain percentage, but it is ownership in the company is sold, or the right to buy ownership is sold, and investors in the contract have stipulated that it can be repurchased. So either at a predefined multiple, or at a mutually agreed upon price at a date in the future. And there's a few different ways that this can work. I'm happy to go through more details on any of these in the questions. I've got some slides with how the cash flows work. But what is different about redeemable equity to traditional equity is that there is essentially in the contract a redemption clause that is pre-negotiated, and allows the entrepreneur to, if they want to, create either a full or partial exit for the investor based off of those terms. And I say full or partial because there are some that are being done as 100%. You can buy back 100% of the equity. But what I'm seeing a little bit more, particularly for traditional VCs that are kind of looking at this from a structuring perspective, is that it's actually a partial exit. So the investors make their return, but allow only 50, 60, 70% of the shares to be repurchased and keep that upside just in case, the company does, get sold or has significant growth. So those are the 4 different categories. And I think I'll go through a little bit more on them, but just to say that I think it's important to remember, and I'll get to, I see there's a bunch of good questions, which is great. I'll get to them in a little bit and we'll continue to discuss, but it's important to remember that traditional VC portfolio construction depends on, a win, if not maybe 2 wins. And I've taken this kind of traditional map and turned it into, because I was writing for an international audience, turned it into a lot of different sports that aren't just American sports of baseball. And so, but the bottom line is, and Honor's made this point as well as others in writing, is that VCs are looking for somewhere between 2.7 and 3 times return on their cash on cash over the life of the fund. And what's interesting and that I've seen from these investors that are using anything from convertible revenue-based financing to redeemable equity is that the portfolio construction can actually be done in a way that that same cash on cash is the target. It's just that instead of getting your cash from 1 to 2 companies, you're actually investing in a much higher hit rate and your liquidity is happening earlier. So whether it's dividends that you're getting paid out earlier as stipulated in convertible RBF, where you're getting a revenue-based or a cash flow-based payment starting from, say, year 2 or 3 or 4, or in redeemable equity, where you're having your shares repurchased, potentially also starting from year 3, 4, 5. You're getting the cash flow earlier, which obviously doesn't help with your cash on cash, but does help with your IRR calculation. But you're also making bets in companies that are not, doesn't have to be better developed, but are more likely to actually make that return. So instead of looking for the company it's going to be the next Facebook, you're actually looking for a company based off of your modeling that will be able to return that maybe 3 to 3.5 times for each individual company that you're looking for, to a certain degree of certainty. Obviously not 100% and probably not 80%. But if your portfolio hits 60% of the time and you're going for about a 3.5 times return, then the math actually works out to where you're still going to be getting somewhere in that 2.7 times cash on cash, which then can rival a traditional venture capital fund. So it's just, and obviously as impact investors, there can be decisions made around this, around the type of return that you're looking for. So this is not specifying that this has to be a market rate return type of structure. But what is fascinating to me is that from a portfolio construction perspective, we can actually construct portfolios that are as high of a return, or as, kind of target traditional market rate, using these new structures. So there is obviously the question is why would you trade off upside? And that is a question that we can discuss. But at the same time, these are potentially using these structures and, maybe using multiple of these structures or one of these structures within a portfolio does provide the opportunity to create a different story for LPs. And potentially not a less lucrative one, but a different story and for a different type of company. So I'm just gonna, to finish off, I'm happy to do some more questions and things. I'm just gonna go, I won't go through any of these, but there's lastly, so one of the things that I did as I was sitting with all of these wonderful term sheets that I actually loved. So thank you if anyone on the call gave me term sheets, that was wonderful. What I've tried to do is to really break it down for both founders and funders around the fundamentals of what these contracts are. So you can see on the left, it's the very simple questions. How much do I owe? When do I owe it? How do I repay it? What happens if I raise more funding? What happens if I'm sold? What happens if I default? And then what rights will the funders have? And so I've started to do, there's a bit of this is in the book. More of this is actually going to be up on the online companion in conjunction also with the Impact Terms project, of really trying to parse some of these different areas of these contracts, and then to be able to create the type of contracts that actually do work for the underlying entrepreneurs. And so I think just what I would stress is that the reason that these structures should be and are being created is because entrepreneurs need them, particularly impact entrepreneurs that don't want to be the next Facebook, or are not able to get or don't want traditional equity risk capital. So there's obviously tons more to say, but I think I'll leave it there and maybe just answer a couple questions, Delilah, if it's okay, before we go on to the next piece, or should you want me to just hand over to the next piece? I know I'm right on time.
Well, I think that why don't we go on to the next piece, because I think that some of the questions might be answered in some of the other participants' comments. So I think we'll start with bjlachland, who's the former CEO of Lighter Capital and is a co-founder and CIO of IBI Spike Fund. And I think that we do have a lot of great questions in the chat already. BJ and anybody else who's going to share your experiences directly from the field, feel free to directly respond to the questions in the chat, and I'll try to mentally note that and say, okay, we addressed that. And then when we open it up for broader discussion, we can see what's left. But no pressure to answer the questions in the chat, because we want to hear your thoughts in general. So BJ, please. Thanks.
Yeah, so thanks, Delilah. My name is BJ Lachland. As Delilah mentioned, I was the CEO of Lighter Capital for about 7.5 years and grew from we mostly did revenue-based financing, and we're the highest volume provider of revenue-based financing in the US. And it was very much traditional, and Ani's sort of scale, very much traditional for revenue-based financing, non-dilutive capital. During my time there, we did about 700 financings. We were doing about 150 a year. These are typically longer term financings than you see with a Clearco or something like that, that I would categorize a little bit more like merchant cash advance. And that distinction between merchant cash advance and revenue-based financing is an interesting one. And so we got really good at going and putting out this money. And as Delilah mentioned, right now I'm the chief investment officer at a fund called IBI Spikes, and focused on funding tech companies in Israel. And I'm actually in the midst of planning out a brand new fund that would be domestically focused here in the US and North America. So my experience doing revenue-based financing, I've spent my entire career, 20 plus years, on one side of the table or other of financing startups primarily. So I've been an operator and a founder raising venture capital and other kinds of startup finance. And I've also been then a capital provider. I was a VC for a while back in the 2000s, been the CFO of a public company, and then have spent the entire last 10 years doing alternative kinds of financing for a lot of the same reasons that we're discussing here, which is I realized really, venture finance is great and it produces some great businesses and such that employ a lot of people, but it's really the best fit for about 2% of the companies out there. And it's really not a great fit for a huge portion of companies out there and a huge portion of entrepreneurs out there. And it's partly that those companies might not have the potential to be the next Facebook, or it might just be that the entrepreneurs want to build a business that they're not then pushed and forced to sort of exit at some point in time, as most tech startups do. So starting about 10 years ago, I started doing revenue-based financing at Lighter Capital. And at the time, revenue-based financing was very much not an accepted form of financing. We faced all kinds of interesting headwinds, everything from sort of figuring out product market fit to overcoming huge objections from various people in this sort of startup finance community. And I think that's kind of interesting. And one of the topics in here is like, how do you get these instruments to be popularized? And so I really focused a lot of time and attention when we were trying to get revenue-based finance something that was accepted. We really looked at it as sort of a two-dimensional problem in some ways. Two-dimension being, on the one side, we needed to go and attract institutional capital, right, to really scale up this effort. On the other side, we needed to attract customers, our borrowers, and make the product work really well for them. And so we really followed like a 4-point sort of checklist of like, when we went and innovated on anything, did it meet these sort of criteria to go fit? The first one, first bullet point that we really followed was, does it actually enhance the entrepreneur, our customers' optionality? In other words, does it work well with other financing instruments in the ecosystem? Because if we're going to go and popularize an instrument like revenue-based financing or any of these, it's got to work well with all the other types of financing out there. It's got to work well with angel investors, with VCs, with all kinds of things, because entrepreneurs, by their very nature, right, they want optionality. They want capital to go grow their business, but they don't want to be locked out of maybe going the VC route or not in the future. So that's number one. Number two, we really wanted to make it something where there were standard metrics, like with an eye towards going and raising money from institutional investors. We really want to have very standard metrics. Well, standard metrics with something like revenue-based financing is a very difficult thing. It seems like, well, standard metrics should be sort of standard, but revenue-based financing is a variable pay instrument with no real established, at least at the time, standards for like, what is a default, what's a good performing loan, what's a bad performing loan, what's your yield on this, how is it working, right? What's the performance? Until it's fully paid off and you know the exact IRR, you don't really necessarily know how it's performing. So we had to go create a lot of these metrics, and we created amortization methods and things like that we got all kinds of institutional investors to go sign off on, showing that we were making really, really solid returns on these instruments even before they were fully paid off and such. And so that was really, really, really important. The third bullet we had was always start with a customer, and the customer, by the customer I mean, to clarify, a borrower, but internally we'd always would say, this is our customer, and start thinking about them as a customer. It's very easy, I think, at times for capital providers to think of what they need and not think of others, or not think of like their customers and such. So those are some of the major bullet points that we really followed in forming revenue-based financing and really getting it to be popularized. And with that, I'll turn it over to Kim and others.
Thanks, BJ. That's really helpful. And BJ, I understand that you're also working with Kim Folsom, who's the founder and CEO of Founders First Capital Partners. And so, Kim, wondering if you have some thoughts that you want to share from your experiences in the space as well.
Sure, I can go off of mute. Hi, thank you, Delilah, for including me in this discussion. It's an exciting one as well. And I'm Kim Folsom. I'm the founder and CEO of Founders First Capital Partners, and also the founder of Founders First CDC. And we're an accelerator on the one side, and then on the other, we're a direct funder, primarily revenue-based financing, as well as an advisory support platform. And I guess the first thing I would say is I came into this from the perspective of, just as BJ mentioned, as an entrepreneur. Founders First is my 7th venture. And the majority of my 6 companies, I raised traditional equity funding. And the actual cycle of what you go through to create value and take something from idea to actually launch something is not the best fit always for reliant exclusively on equity-based financing. Most successful companies leverage the variety of the capital market stack, but the challenge is most folks don't have access to the full capital markets and also how to navigate that. I agree with the definition that BJ mentioned. The diagrams listed there, what was listed as far as revenue-based financing is more merchant cash advance financing, which is not, in my view, revenue-based financing, because the type of company that it's appropriately structured for is quite different. If you're most companies that are equity financed are B2B companies models, and that has a little bit different cash flow cycle than the traditional e-commerce based companies, and that's where I've seen where merchant cash advance can be helpful depending on where you are in your stage. What we do with Founders First is with the categories that you mentioned is that over my 25 years before launching Founders First with the 6 companies, is that there is a huge growing group of businesses that are have a lot of value locked in them, but without access to capital, have not been able to take advantage of that opportunity. And where they are, the majority of them are not, while they may profess to say they're trying to be the next Facebook because that's what they think you need to do to get access to equity financing, they're better served for other types of capital. And I and my experience as an angel investor got introduced to revenue-based financing because the actual potential growth of these companies may be anywhere from a 3 to 5x. I've also, from my years of seeing that folks that use a source of revenue-based financing, I would say it's probably closer to what you guys had categorized as the revenue-based / convertible component, which is more closer to what we do, but not with the equity converted component. That there's so much wealth that can be created for the investor as well as the entrepreneur out of that revenue-based financing module, and much more optionality. I mean, that can be the quote mezzanine-based financing for entrepreneurs transitioning from as their company evolves and their model evolves as they get stronger, either adoption, product market fit, that provides a lot more flexibility. Whereas if you do all of the growth of the company with purely equity, the entrepreneurs is at a significant disadvantage because they've given away so much of their control of the company before they've really been able to have the time to play out. So in Founders First, our model is that we follow is closer to the revenue-based / convertible note process, but we don't do the convertible note piece. Many of the companies we work with are service-based, and they don't quite fit into the traditional debt, term debt that most people think that has been, defined for them either through the SBA or CDFIs. But the other side of it is this provides more flexibility, and as they evolve their model, they're able to get a performance-based access to further capital. And capital is, staged the way, we are so inspired by what BJ did with lighter capital, is that you still have the same relationship with your borrower like you do in the equity type of arrangement, in that you become their growth partner. And as they grow, you can provide them with follow-on sources of capital at an efficient clip. It's been an exciting road and journey, and to do it at a national platform. And so with that, I'll pause and open it up for some other folks.
Thanks, Kim. I believe we also have Tom Balazis from the Rockefeller Foundation on the call. Tom, if you're there, I understand that the Rockefeller Foundation is getting to be active in this space. So interested in what you're seeing and thinking.
Thanks, Delilah. Yes, I am here. Thanks for organizing. Yes, it's a pleasure to be here. My name is Thomas Balazis. I'm on the Innovative Finance team at the Rockefeller Foundation, as Delilah mentioned, which is essentially the foundation's de facto impact investing, private investing arm. We've been around for about a decade. We've evolved into various shapes and sizes. And the way we currently think about impact investing is sort of multifold. So we have our mandate actually spans across a couple different strategies. On the one hand, we manage a separate fund called the Zero Gap Fund, which I'm sure several folks on the call have heard about. And the focus of that fund is really on investing in the next generation of financial products that have high potential to mobilize large-scale commercial institutional capital towards the UN SDGs. So revenue-based financing, some of these more alternative financing mechanisms have been a huge piece of our thesis and our overall portfolio. In addition to that, we actually play a horizontal role at the foundation. So we actually work with all of our initiative teams, which span across energy, food and agriculture, health, U.S. economic opportunity, data and tech. We actually work with those teams to help them build investment strategies and then invest in companies and fund managers on their behalf. And within our U.S. economic opportunity strategy specifically, that's really been focused on, how do we bring capital to, the 30 million small businesses, many of which are minority-led or BIPOC-led, that are largely underserved by banks and venture capital firms. And so we've been thinking a lot about, how do we create system change in the financial services sector in order to not only bring, debt and equity financing to these companies, but we also think about this in bringing kind of the right kind of capital to these companies and bring the right kind of instrument that's best served to meet the needs of the various founders and business models out there. So we don't look at the sector as binary, as just a debt and equity play. There's a couple investments that we've made to support this effort, one of which was in Founders First. And we also recently announced an investment in a fund manager called Apis and Heritage, which provides mezzanine financing to small businesses in order to facilitate ESOP buyouts and support employee ownership into these companies, which are largely hiring minorities and BIPOC employees. And as with all of our portfolio, we think a lot about, not only the potential of this product, but what needs to happen in order to demonstrate it, improve it, and what are some of the key challenges that we need to address in order to make these products institutional asset classes that can fit the needs of the large pension funds, endowments, et cetera. And so within revenue-based financing specifically, which is an area that I've been spending a lot of time thinking about, I think there's three sort of challenges that we're currently focused on that we're looking to address. One of which I think is an obvious one is just pure size. We see a lot of potential in the RBF space. Most of the players out there, like the Founders First of the world, are small platforms. They're small platforms and are too small to absorb the large checks of the major institutional investors. And so what we're really focused on is trying to build these companies, build these platforms so that they can meet the large investment sizes of big institutions. So that's one of the more obvious ones, just in getting this asset class to scale. But size isn't really, from what we've observed across a lot of asset classes within impact investing, size isn't necessarily the only part of the equation. If you look at the CDFI industry, for example, which is a $10 billion industry, it's been around for a decade. It took a long time for them to sell their first AA rated impact bond. And a large part of that, from what we observed, is really just investor awareness. We did a deal in the CDFI space recently, and the CIO of our endowment had no idea what a CDFI was. And so I think as we work with all of these different companies and fund managers, really thinking about how we can bring institutional investors to the table so that they can start thinking about how to bring these products into their own portfolios sooner rather than later is super important. And then alongside that, we also need to be building the data set in order to prove that these are actually investable and attractive assets. So we think about revenue-based lending. We really do see this as a product that can be interesting for institutional investors, particularly in this interest rate environment where investors are really hungry for yield. If you can provide a product out there that is providing debt-like behavior, but is actually performing a lot like equity, that's something that we think that institutional investors should consider having in their portfolio. But we first need the data and the track record to actually prove that this is investable. And I guess the last point that we're really focused on is just the overall funding model. There's a lot of folks out there that have been trying to think through, how do we provide capital to, this large swath of companies that aren't getting access. And a lot of these models from what we've seen have been, largely unsustainable. For example, within the fintech space, you have a lot of companies that are looking at, alternative data models to provide quick underwriting to companies, but charging fairly high interest rates in order to account for, fairly high predicted defaults, investing a lot in customer acquisition. And as we observed last summer during the COVID crisis, during the lockdowns, and small businesses were particularly impacted, a lot of those portfolios proved to be incredibly, the resilience of those portfolios was really stress tested. And so what we're really focused on is building, not only having the right asset class, not only having the right instrument, but also having the right funding model that is focused on building a resilient portfolio and generating the cash flow, the consistent cash flows that we think can be appealing to institutional investors.
Thanks, Tom.
So I'll pause there.
I don't want to interrupt you. You're making really important points, but I also want to highlight that Brendan Cosgrove, who's been doing work with the Kauffman Foundation, probably has some similar thoughts, experiences. Interested to see what you're doing, Brendan, around the field building in this space, alongside the Rockefeller Foundation as well.
Yeah, thanks for the intro, Delilah. And I think Thomas is stealing a lot of the points I was going to mention. So I don't have too much out there, but to give a little bit more background on what we're doing at Kauffman, we started the Capital Access Lab initiative at the beginning of 2019. We were seeded by a $3 million grant from Kauffman. We're structured as a donor advised fund. And our whole thesis was 83% of entrepreneurs in the US do not access traditional sources of capital like VC or bank debt. We wanted to take more of a fund of funds approach where we are seeding first time and emerging fund managers that are using innovative financing models to reach those 83% of entrepreneurs in the US. So what that looks like in practice, we're actually fully committed as of today across 6 funds, where for the most part, we were making kind of anywhere from $400,000 to $600,000 LP commitments as one of the first LPs in these funds, one of which is Kim Folsom from Founders First. And we really wanted to be able to test out these innovative models because a huge hurdle to bringing institutional capital into this space is really is the lack of a track record, whether it's redeemable equity, RBI, ESOP financing, kind of all of the above. And a lot of the institutional LPs that I got to talk to through this process, a lot of them do not know where to put those fund models in their kind of more traditional asset classes. And also, the majority of fund managers out there that are in this alternative capital space do not know there's scale issues. A lot of these funds are too small for kind of getting into the endowment side of their portfolios. Without the kind of 5 to 10 year track record for fund managers, there's another kind of hurdle on the traditional institutional due diligence process. And then also, I think with anything that's new that institutional LPs have not backed before, it's very hard to benchmark these emerging fund models. And so that is kind of what we heard over and over again. A good example of that is we backed Indie VC, which a couple months ago reported that they were going to shut down their main fund as they were shifting more to redeemable equity from traditional equity. Big reason for that was because institutional LPs wanted them to keep doing writing kind of seed stage equity checks versus this new model, because they had been doing historically so well on the traditional equity side. So that's just kind of one of those examples where I think it's hard to put, not all of these alternative models look the same. It spans anywhere from kind of early growth equity up to kind of opportunistic private credit. It really depends on how these term sheets are structured, the types of small businesses that are backed by the fund managers. So there's a little bit more nuance involved with that. I would say an early success for us, beyond obviously Kim at Founders First, is Collab Capital, where we were the first LPN. They have this innovative profit sharing model. They were originally trying to raise 15 million, increase that to 25 million, and then 50 million, and just closed on the $52 million first fund. And they, 3 GPs from Atlanta, all former entrepreneurs, operators, no real track record, but wanted to build an investment firm that they wish existed when they were raising capital as entrepreneurs. And so we're seeing a lot of that, where it's these mix of place-based funds, but also emerging fund managers from overlooked cities across the US that want to bring the right type of capital to their communities and small businesses in their network. So I'll stop there, and hopefully I didn't eat into Heather's time.
Thanks, Brendan.
Yeah.
And that's great. And last but not least, Heather Matranga from Village Capital, the Senior Director of Strategic Innovations.
Thank you, Delilah. Thanks for having me here. Really honored to be discussing this with all of you. I have to say that listening to the trailblazers with Lighter Capital and Founders First, and all the work that Rockefeller and Capital Access Lab are doing to support the development of the ecosystem. And then of course, Ani literally wrote the book on this. I certainly don't have that level of expertise. We come at this much more from a practitioner implementation standpoint, where Village Capital, our mission, our focus is really to what we call reinvent the system to support entrepreneurs of the future. And for us, we see that entrepreneurship is a critical tool to solve some of the world's biggest problems. But to really do that, we need diversity of ideas and perspectives, and entrepreneurs with lived experience. And all too often, we see entrepreneurs left on the sidelines, and Brendan went over this a little bit, where 83% of companies in the US don't have access to financing. And we also know the stats where less than 1% of venture capital in the US goes to Black founders, less than 15% goes to companies with a female founder on their founding team. And so our interest is really in being creative and innovative and experimenting with new ways of supporting entrepreneurs to help address some of these issues and help grow the impact of early stage companies. And so we really think about not just who we're investing in, but how we're investing. One of the core ways that we've innovated is really evaluating how decisions are made, and leveraging a model that we call peer selection, where we have entrepreneurs make our investment decisions on our behalf. We've also experimented with different investment structures. So you've heard a lot about revenue-based financing today. We've used that structure and many of our investments as a way to help support early stage companies where equity just really wouldn't make sense and isn't the right fit. I think through this, what we've really realized, like one of the focal points for us is through this is trying to evaluate what's working and in what circumstances and what isn't. So we actually partnered with MacArthur Foundation about 2 years ago to look at when revenue-based financing it could be most effective, what ticket sizes, what stages, what types of business models. I'm happy to share that report with you. I think that Lighter Capital and Kim from Founders First will also be able to answer that just based on their own experience. But we've also evaluated when it just isn't working. And so we see some challenges, and I think there were some questions in the chat about, is this new? Is this new to the ecosystem? When are some obstacles for it? And for us, entrepreneur interest is an obstacle that we face just because it's still a newer model with revenue-based financing. So there's skepticism, particularly for entrepreneurs that maybe are first-time founders and aren't familiar with different structures and think debt and equity are really the only two available structures out there. Like relatedly, the investment community is still starting to get familiar with this. So when they see, a revenue share debt sitting on the books of the entrepreneur, and they want to come in with maybe a Series A or equity investment round, it gets them a little bit nervous. And then also for us, we work with early stage entrepreneurs, and it's not always well suited for pre-revenue companies that really need that catalytic initial investment. And so we've been thinking a lot about one of the other structures that Ani mentioned, redeemable equity as a potential structure for us to use. I think the last point that I would make is we've talked a lot about how this tool is really powerful. These tools are really powerful and helpful for entrepreneurs because we can support a broader swath of entrepreneurs where equity maybe just doesn't make sense. So thinking about these structured exits, instruments that fit within structured exits. I would also say that there are a growing number of corporate foundations and other sort of impact-oriented investors that want to start to invest in companies and do so with smaller fund sizes and want a lot of liquidity in their investments. And so these structures are really interesting for them because they don't have to wait 10 years to actually see a return on their fund and then prove, like internally to their corporate, CSR team, prove that this is a viable option to support companies and support impact. So with that, I'll turn it back over to Delilah. I'm happy to answer any questions.
Thanks, Heather. So these are great perspectives from a range of practitioners and thought leaders in this space. I think from an institutional investor perspective, we talk a lot about the entrepreneur's perspective and access to capital for them, but also this is a diversification opportunity for institutional investors to reach more businesses, more segments of the market. And I think that's an interesting angle as well. I've been trying to keep an eye on the chat, so I'm going to call on folks who I think their questions haven't been answered yet, but feel free to say now. I picked this up, between the lines of what people were saying. So I noticed from I'm just going in chronological order, Allison Shapiro asked a question about how tenor is negotiated. Allison, do you feel like you picked that up, or would you like some additional detail on that? And feel free to unmute yourself and take your mic off, because we have a lot of people, but we're trying to curate an interactive discussion.
I don't think Allison's on anymore because I actually was trying to respond to her, and I think she's signed off, unfortunately.
Okay. All right. Thanks, Ani. Well, then let's move on to Scott had a question. Scott, do you want, I noticed that we have a few Scott Kelbs on the line somehow. Scott, you must have shared your dial-in, which isn't a problem at all. But does the Scott Kelb who asked the question about these structures being an alternative form of private credit for LPs. Do you want to elaborate on that at all, or just hear the answer?
Yeah, I actually, I put two questions in there. The first one is, it seems that regenerative financing structures or revenue-based financing structures are really designed to give a consistent sort of yield type return back to LPs. And so I'm wondering if LPs should be thinking about these as an alternative form of private credit rather than, VC or, even private equity, where, the model is you're chasing, extremely, high returns on a few investments. You've pointed this out. The typical model for private equity is, every 10 investments you do, maybe 3 are big winners. And in VC, for every 100 you do, maybe 5 are big winners. And that's where you make all your money. And it seems that this kind of model is really not, it's sort of the antithesis of that. It's like trying to make a consistent return from everything that you got. So I'm just wondering how LPs, if you're going to attract capital into these things from LPs, they need to think about how they want to place it in their portfolios.
Delilah, do you mind if I just start with that one?
Yeah, go ahead. And also, just for context, I think it's good for everybody to introduce themselves in terms of, what hat they're coming with. Scott, I hope you don't mind me just briefly saying that you're the former CIO of a sovereign wealth fund and run an initiative for sovereign wealth funds and public pension funds focused on responsible investment. Is that a good?
You got it. That's good.
Okay.
Stop right there. Yeah.
So Scott, I just say, like, also just to kind of, BJ and Kim's comments around the merchant cash advance, that's actually why I separated revenue-based financing from merchant cash advance, because that's in the book as well, but it sits outside of kind of these. It's a much more short-term financing, and is very much, it's much more similar to kind of trade finance and other kind of those types of working capital. I agree with you. I see this revenue-based financing, and I've split it in my thing, and I understand the categories aren't going to work for everyone. It was an impossible task trying to parse these in ways that make sense. But I do really see in this idea of the revenue-based financing that Lighter has done, and kind of Clearco and others that are actually do look a little bit more like debt. And I would say that, like, a lot of companies are actually doing a lot of different types of revenue-based financing. The term has become, I think, a bit too broad, because that's kind of partially why I think it needs to be split. However, it needs to be split. There's a type of revenue-based financing where you are looking at earlier, riskier, more kind of VC-like portfolios. And then there's a revenue-based financing where you are looking at it as more like debt, often beside VC, but is a more consistent revenue stream, and your portfolio construction is going to look very different. So I think there does need to be a split, because if you're looking at what Viwala's doing down in Mexico, it looks much more like debt, and they're working with very small companies to provide them the working capital they need on very flexible terms, as opposed to what, for instance, Kim's doing at Founders First, which is making really calculated, great, really good investments into companies, but that aren't necessary. Kim can discuss if she would consider herself private credit. I think that some of these, that are veering more towards the VC, it doesn't fit in that category. And so I think right now there's the catch-all term, because they all have some sort of revenue-based repayment, is being used too broadly. Just because it's revenue-based repayment doesn't necessarily speak to the underlying risk profile. And so there is a need to kind of segment, I think, the space a bit.
Yeah, I wouldn't mind adding to that. I agree on to like the term revenue-based financing has become really broad, and just like any sort of emerging instrument, it's going to go through its sort of definitional semantic changes and such, and still finding its way. I think in the revenue-based financing that I've mostly participated in, and going and pitching institutional investors, and I've probably pitched 50 institutional investors on revenue-based financing and stuff. And to answer your question, all of them basically put it into the private credit group. So I would always get matched up with private credit group. And I think that that was appropriate, especially the version of revenue-based financing that we were doing at Lighter. Looking at the portfolio we had, our loss rates, our default rates, impairment rates, yields, that is very much the language we use to describe it and the metrics we use to describe it. And so that very much stuck us into the private credit groups and such that they were really able to actually look at it. And I actually think in terms of making some of these instruments popularized and making them like much more common and accepted in a mainstream way, I always felt like it was better to be pitching the credit folks than the equity folks, just because number one, those pools are dramatically larger. Number two, just given the macroeconomic environment, we're living in such a yield constrained world that if you could provide a good, consistent yield and have a great sort of diversity in a pool of assets, stuff like that, there was a lot more money out there that was possible to get. And I think that also then translates into a lot more money that's possible to get behind these new instruments. Whereas in the equity world, it just took so long. Number one, the pools are smaller from limited partners and such. Number two, it just took so long to get a track record going that for us at Lighter and such, it was just so much more difficult to get through that time horizon of proving out that track record. Having something that could be characterized as a yielding vehicle and look more like something the credit group could get their arms around and their brains around was just such an easier path. And I think of truly a better fit.
Hi, let's see. Oh,
Somebody going to say something?
Yeah,
Kim.
this is Kim. Yeah, I guess I was just going to comment with regards a couple things. One on the profile. The profile of the company that we are targeting, it's not that they're, substantially below the credit scale. It's more of a function of just on regards to access to capital in itself. Kaufman did a really great amount of research that they published around the access, the different either equity or debt instruments and that how they're used by women and people of color. And, both have been dramatically under allocated with both of them. But the folks that did get those types of capital did perform at or above, their primary counterparts. So I want to distill this notion that, if you're funding diverse founders, they're substantially of a lower credit grade. Access is an issue. But then the other factor is there are other elements that haven't provided them with access to capital, business financial resources such as business financial health, use of other solution providers. When you look at how many diverse founders actually took advantage of, a very popular public program in the PPP financing, without having access to capital to actually create the infrastructures needed, it's difficult to be able to take advantage of those largely publicly available resources if you don't have those things in place. The other, back to the ability of the return for investors and other LPs to attract capital. When I started Founders First, some almost 6 years ago, and I told folks we were going to use this model to go after this market, because the ability to show liquidity when you compare that to equity, just as BJ said, it was, people were cautious and said, I haven't yet seen that same thing happen. But over the, after a year, 2, 3 years, being able to show quarterly distributions with some predictability, change those skeptics into supporters and eventually advocates. When you compare that against an equity fund manager that has to wait until they get an exit, and that can take, in this market, anywhere from, at best 7, worst case 12 years, if at all. And so that has been helpful to, our goal is to not only, address the one side of the market of providing capital to thousands of diverse founders, but then the other to show the capital markets that there is this instrument to provide them access to funding this underrepresented group that can provide them with great returns and prove that you can indeed do good and do well.
Thanks, Kim. We have some more time for questions or comments from anybody in the audience. It doesn't have to be a question. It can be sharing your own perspectives from your work in this space. We have a lot of very experienced professionals here. You can use the raise hand function or raise your hand physically or put a thought in the chat.
Can I jump in with another question, please, Delilah? It's Scott Kalb.
Sure.
One of your Scott Kalbs on there. Yeah, so thank you very much for the answer to the previous question. It does seem like, you know, you might find a more ready audience among the LPs anyway, or the asset allocators or owners on the credit side, you know, and potentially you could really attract some capital. The other thing though is I'm wondering what's the, you know, what kind of reception are you getting from the GPs to this concept? I mean, it looks like a way to push back on high fees from GPs who, you know, are, you know, historically in the VC world and in the PE world, you know, there's a big part of, you know, the capital is actually flowing to the GPs, and also that incentivizes them to add on leverage, as you point out, and to also add debt onto the companies and so on. So the flip side, though, is that I'm not sure that this kind of structure is as attractive to the GPs to get involved in. And if you're going to be successful in attracting capital from the big asset allocators or asset owners, they're going to need GPs to come in, and you know, you need to broaden the market of GPs who are going to be offering these structures. So maybe you can just address that point. Do you think that GPs are really going, you know, that we've got a good chance to widen this market among GPs?
I mean, I can speak to that briefly if nobody else who, you know, Ani, I don't know if you want to respond to it, or if anybody else who's already spoken, and anybody in the audience can also respond to it. But you know, I think from my perspective, one of the things that we talk about in ESG 2.0, the paper we wrote that I mentioned, is the consolidation of capital flows to the same GPs. And when these GPs have so much capital to put to work, they try to do so efficiently, and they end up chasing a lot of the same deals, and that pushes valuations up, and returns get eroded away. And there are incentives to layer on leverage, as you mentioned, Scott. So I think that, you know, these structures are interesting, as I'm not sure if the existing sort of incumbent GPs will eventually catch on and see this as a way to pitch diversification and positive impact to LPs, and start to create funds with these structures. I mean, that certainly happened with mezzanine debt for other features that mezzanine debt and private credit have. And I could see a similar dynamic or pattern happening with these structures. But right now it seems like there's a huge opportunity for the smaller GPs to build their AUM and build their track records. And so, you know, there are certain sort of maybe mid-sized LPs that could be well positioned to make smaller investments in these smaller GPs and eventually scale the pace and its space, and it can build the track record and, you know, get the data that we need to make this more mainstream. I don't know. It's just thinking out loud. It's not a clear answer to your question, Scott.
I
But
can.
hopefully, yeah.
Oh, sorry, Delilah. Yeah,
Go
I
ahead.
can add to that a little bit. I think it's kind of interesting. It's more some of these emerging or established VCs that have a sector focused approach have started to launch dedicated RBI funds in that same sector, because like we're seeing a lot of these great deals come through, but the VC model doesn't work for this business. And so one of the funds we backed, Anzu, actually did exactly that. They had raised 2 or 3 institutional size early stage VC funds focused on industrial tech businesses, and then launched their first revenue-based fund to do the same approach, but for kind of later stage, more mature businesses that didn't have a clear path to exit. So I've seen more of that, and a lot of VCs also kind of view this as complementary to their early stage strategy as well, to almost improve the equity returns by also being kind of on the debt side of the capital stack. And so that's one thing I think with the larger GPs, like the big buyout firms, the mega cap or large cap or even middle market. I think these transactions are just way too small and not worth their time or energy, because it takes the same amount of time to diligence, if not more. So this isn't worth it to them. They're going to keep doing what they've done historically. I think with some of the more lower middle market, small caps, growth equity and buyout firms, this could be something, kind of another tool in their financing kit. If a business is, they want to add RBI as part of their existing strategy.
Thanks, Brendan.
Yeah.
I just want to make sure that we adequately addressed Tatiana had a question in the chat. Tatiana, did you want to chime in with anything? I also saw Michaela take herself off mute. I don't know, Michaela, if you want to say something.
So I was looking for the unmuting
Tatiana.
thing. Yeah. Thanks. So I see some examples. I'm definitely gonna have a look at that. This question came because, in particular, let's say in Central Asia, let's say Tajikistan. I don't know if you guys have any experience in these kind of countries that were never let's say liberal enough. So Mexico is not an example that would work for me. Its proximity to the States basically makes it a little bit more advanced than those countries. So their exits are extremely difficult. So, but I don't think for equity investors, but I don't think the option of having this redeemable equity would actually be even possible there, because the regulator would not know how to work or how to deal with that. That's why I had this question, if these things are already tested, maybe, but maybe we'll have to test it ourselves.
Can I just do a quick plug? If anyone, please do shoot me a mail. I'll put my mail in the chat. But there is some work that I and other partners on the call are planning to do around redeemable equity, Tatiana, particularly because of this reason. RBF super easy in the sense of it's just a different type of loan financing. We haven't seen a lot of issues, but redeemable equity sits in a gray area, and so there does need to be some work around tax, legal, and just jurisdictionally in a few different jurisdictions. And so planning to start that work actually next week. So if anyone's interested, please shoot me a mail, and I'll keep you updated on how that work progresses.
Thanks, Ani. And thanks, Tatiana, for that great question. So we are approaching 12:15 Eastern time, and it's time to wrap up. So thank you, everybody, to Ani, to everybody who shared their perspectives from working in the industry, to all the participants. And I think what we'll do is, after this webinar, send an email with some additional resources for you all to dig into. Hopefully this is the first of a longer conversation. We're certainly continuing our research on the space, and invite you to join us on that journey, as Ani puts it, in the book. So thank you again, and have a great day.